Imagine this. You saved for years. You finally have enough to start investing seriously. You're ready, and you put everything into the stock market. And then the market drops 90%. Not 10%, not 20%, 90%. That actually happened. In 1929, the stock market went from 391 down to 41 over roughly 2 years. If you had invested at the peak, it would have taken 26 years to fully recover. 26 years. That's the nightmare scenario everyone fears when they think about investing in stocks. But here's what's fascinating. I learned this from J.L. Collins' stock series. Even in that worst case disaster, the absolute mother of all crashes, there were ways to not just survive, but actually come out ahead. And understanding how changes everything about how you should invest. I'm 10 years into this financial independence journey now, and I've been through a few downturns. And what I've learned is that the fear of crashes is way more dangerous than the crashes themselves. So let me show you what most people get completely wrong about market crashes, and what you actually need to know to protect yourself and still retire on your terms. Let's start with the big one, the 1929 crash, the Great Depression. This is the event people point to when they say the stock market is too risky. And look, it was brutal. The market peaked at 381 in September of 1929, and by July 1932, it had fallen to 41. That's a 90% loss. Your $100,000 would have become $10,000. But here's the critical question. Who actually lost everything? It wasn't the people who just owned stocks. It was the people who bought stocks on margin. Margin means you're borrowing money to invest. So let's say you had $10,000. You could borrow another $10,000 from your broker and invest $20,000 total. If the market goes up 20%, you don't make $2,000. You make $4,000. You've doubled your gains. Sounds great, right? Except when the market drops, you still owe that borrowed money. And if your investments drop too much, your broker makes a margin call. They demand you pay back what you owe immediately. And if you can't, they liquidate your account, you lose everything. That's what wiped people out in 1929, not the crash itself, the leverage. I'll be honest with you. Early in my investing journey, I looked into using margin. I watched all these videos about how you could amplify your returns. It was tempting, but then I thought about it. What happens if I'm wrong? And that question stopped me cold. Because when you use margin, you can't afford to be wrong. One big drop and you're done. Game over. So lesson number 1, never buy stocks on margin. Ever. The upside isn't worth the risk of complete wipeout. But the people who owned stocks outright, without margin, even they went through hell. But they could survive. That's the difference. Now here's what's wild. The 1929 crash didn't just come out of nowhere. There were warning signs everywhere. People just ignored them. There's this famous story about Joseph Kennedy, JFK's father. He supposedly knew it was time to exit the market in early 1929 because his shoe shine boy started giving him stock tips. Think about that for a second. When the person shining your shoes is telling you which stocks to buy, everyone's in the market. And when everyone's in, when it feels safe and easy and obvious, that's when you should be nervous. Here's a psychological trap we all fall into. We want to buy when it feels safe, when everyone's making money, when your coworkers are bragging about their gains, when investing seems like free money. But that's exactly when things are most dangerous. The irony is that the best time to invest feels scary. The worst time feels exciting. So what do you actually do when you notice euphoria building? 3 things. 1, don't touch margin, ever. It doesn't matter how safe it seems or how much everyone else is using it, just don't. 2, don't increase your investing beyond your normal monthly amount. If you're putting in $500 a month, keep it at $500. Don't suddenly dump in $5,000 just because stocks feel like a sure thing. 3, definitely don't chase whatever's hot. I saw this during the 2021 crypto boom. People who had never invested were suddenly experts, throwing money at whatever coin was trending that week. Most of them lost. You're not trying to time the market here. You're just protecting yourself from doing something stupid when everyone around you is doing something stupid. Stick to your strategy, especially when everyone else is losing their minds. Alright, so here's the question. What if you do buy right before a crash? What if your timing is terrible and you invest right at the peak? Most people think that's a disaster you can't recover from, but the math tells a different story. Even if you've had the absolute worst luck and bought at the exact peak, which is nearly impossible to do consistently, you still recover if you kept investing. That's how little timing actually matters. The 26-year recovery number everyone quotes, that's only if you bought at the absolute worst possible moment, the peak in September 1929, and never invested another dollar. Any other scenario would have been better, sometimes significantly better. Here's a more recent example. Think about someone who started investing in 2006, right before the 2008 financial crisis. Terrible timing, right? If they kept investing through the crash, and this is key, putting in the same amount every month no matter what the market was doing, they were buying stocks on sale during 2008 and 2009. That's called dollar cost averaging. Same monthly investment, but when prices drop, you're buying more shares. By 2012, 2013, they were way ahead of someone who panicked and stopped investing, or someone who sat on the sidelines waiting for the perfect time. Bad timing hurts less than you think, as long as you don't panic and sell at the bottom. And that brings me to the most counterintuitive truth of all. A market crash early in your investing life is actually a gift. I know that sounds insane, but hear me out. Let's say you're 30 years old. You're just starting to invest seriously. You've got 20, maybe 30 years before you retire. And let's say the market crashes 50% next year. If you stopped investing, yeah, that's a disaster. But if you keep investing, you've just got handed decades of buying stocks at a discount. Think about it. You're putting money in every month, and now, instead of buying stocks at $100 a share, you're buying them at $50 a share. Same dollar amount, but you're getting twice as many shares. When the market recovers, and historically it always has, those shares you bought on sale are now worth full price or more. If you're in your 30s or 40s, early in your financial independence journey, you want crashes to happen now, not when you're 65 and trying to retire. Now, while you're still accumulating. I get it. It doesn't feel like a gift when you watch your account balance drop. It feels terrible. You open your account, see red numbers everywhere, and your stomach drops. Every instinct is screaming at you to stop, to protect what you have left. But that's the trick. You have to think long term. You have to separate your emotions from the math. Here's another way to think about it. Imagine you're planning to buy a car next year. Would you rather car prices stay high, or would you want them to drop 30%? Obviously, you want the discount, right? It's the same with stocks. If you're not retiring for 20 years, you want stocks to be cheaper while you're buying. The worst thing that can happen early in your investing career is a smooth, steady rise with no crashes, because then you pay full price for everything. And when the inevitable crash comes later, maybe right when you're about to retire, that's when it really hurts. So if you're young, if you're still building your portfolio, reframe how you think about crashes. They're not threats, they're opportunities. Here's the big question. Should you actually be worried about another 1929? Let's look at the numbers. A 1929 level crash has happened once in over 100 years of stock market data. Once. We came close in 2008. Really close. I think closer than most people realize. But we didn't go over the edge. Why not? Because after 1929, we made a lot of changes to economic policy. We created the FDIC to protect bank deposits, so even if your bank fails, your money is insured up to $250,000. We created the SEC to regulate markets and prevent fraud. We put safeguards in place. Are those safeguards perfect? No. Could we have another Great Depression? Yes, it's possible. But here's my take. You shouldn't build your entire strategy around avoiding the rarest event in history. That's like never driving a car because you're afraid of an accident. But you should make sure your approach can handle it if it happens. Think of it like wearing a seatbelt. You're not obsessing over crashes, but you're protected if one occurs. And the answer is yes, you can survive it if you follow a few basic rules. 1. Don't invest money you'll need in the next 5 years. If you need cash for a down payment, a car, or anything else in the near term, keep it in something safe. Stocks are for money you won't touch for at least 5 to 10 years. 2. Have an emergency fund. 3 to 6 months of expenses in cash. This keeps you from having to sell stocks at the worst possible time to cover an unexpected bill. 3. Think in decades, not months. When the market drops 30%, that's noise if you got 20 years ahead of you. It's only a crisis if you're forced to sell. If you do those things, even a 1929 level crash is survivable. It'll suck, it'll test you, but you can make it through. And honestly, the biggest risk isn't a crash. It's sitting on the sidelines in fear, missing out on decades of growth because you're worried about something that may never happen. Everything we just covered, surviving crashes, staying invested through downturns, building wealth despite market chaos, all of it works if you have the right tools in place. And here's what I've learned. You don't need a lot of tools. In fact, most people overcomplicate this to a ridiculous degree. There are only 3 investment vehicles you actually need to outperform 80% of professional investors, and they're shockingly simple. Plus, there's one investment company that's structured completely different from every other company out there. It's built so that when they make a profit, that profit goes directly to you, not to shareholders, not to executives, to you. Most people have never heard of this structure, and it's one of the biggest advantages you can have as an investor. So that's what I'm breaking down in the next video. The simple 3-tool portfolio that protects you from everything we just talked about, and why this one company should be at the center of it. If you want to actually build a portfolio that can survive anything the market throws at you and still get you to retirement, that video is a must watch. I'll see you there.